The present economic whirlwind might hit US importers as well as exporters from several economies globally. And you know what? Today, banks may not be best equipped to help them, as they are themselves suffering from a structural liquidity crunch. So, are we staring at an irreversible decline in bank deposit growth? Yeah, most probably. This article is divided into two parts. The first and smaller one talks about the deposit crunch being a global phenomenon, and the second one talks about the case of India in detail. In China, the People's Bank is lowering interest rates to boost the economy. Other banks are having to reduce their deposit rates as a result, and that makes people move away to gold and real estate and even cash. In the United States, deposit growth has been declining since more than 2 years and has now gone below the personal savings rate, which means that people are instead investing in mutual funds, which are directly investing in the Federal Reserve bypassing banks. In the next part, I'll discuss the specific case of India. India is facing a similar deposit crunch like banks elsewhere in the world. NBFCs are providing better interest rates on their fixed deposits. Just look at the growth of the asset under management of mutual fund industry. And then the market cap of listed companies. That's gone to a staggering 400 lakh crore rupees with a 15% CAGR. Still, due to safety, liquidity, and familiarity, people are depositing money in banks, which makes the current bank deposits in India near 220 lakh crore rupees. Most of it is household deposits, and half of that are demand deposits or CASA, cheap money for banks. But look at this graph. The CASA of banks across the board have been dropping. People are becoming smart. They are investing in mutual funds. They want greater returns. But while the deposit growth hovers around 11%, lending grows at 15%, which shoots the loan-to-deposit ratio beyond 80%. Moreover, India is expecting a 4% inflation this year after years of high inflation, and that's nudging the Monetary Policy Committee to cut the repo rates. But this might replicate the Chinese experience in India and cut down on banks' deposit rates, which may move people from banks to the capital market. And here's about lending. When banks are running on thin margins, they'll be highly selective in lending. The downstream borrowers will suffer. MSMEs may suffer. Government scheme beneficiaries, for example, under priority sector lending policy, may suffer as well. Banks will be very selective. And remember, a few months back, the exchange rate of rupee went over 88 per dollar, and RBI had to literally sell $77 billion from its forex reserve to stabilize it. The rupee liquidity that it sucked out in the process created a deficit of 3 lakh crore rupees in the banking system. Now, although this deposit crunch is a structural issue and only structural reforms like deregulation can solve it, if something is not done immediately, the bank-oriented economy of India might suffer a credit shock. So RBI stepped in February this year, and with a series of open market operations, pumped in lakhs of crores of rupees into the economy, converting this 3 lakh crore rupee deficit to a nearly 90,000 crore rupee surplus by the end of March. The drastic open market operations done by RBI has surpassed the record of last 3 years. And that's it. There's no conclusion in this article because things are dynamically changing. Tomorrow, April the 9th, American tariffs will come into effect. Many economies may come up with their statements, and India has its Monetary Policy Committee meeting to possibly cut down repo rates again. Things are pretty dynamic, and we may have a new article on Beacon Economics pretty soon. So head over to the complete article in the provided link and subscribe to get all future articles for free directly in your email. See you.